Hello everybody, so welcome to this video. We're going to talk about some of the health stocks really dropping this week. So the question is, why so cheap? And I will walk us through the new valuation I've updated my spreadsheet for all four of these stocks. The first stock, of course, is Cormedix, most requested in the comments section, so we'll see if this part gets any views. Cormedix is dirt cheap. It's not even dirt cheap. I mean, with the new quarter, with the new revenue numbers, and the gross margin that hasn't changed much. EBITDA margin actually. Very high at 41%, stunning company. It's 0.03. The point here is that when I started covering this stock, it was trading at a 0.06. So this is a stock that is now twice as cheap as it used to be. This is also a stock, and twice as cheap in like a matter of 2 months. This is also a stock who, you'll notice, have left forward growth for 180%. But ask yourself: are we really gonna do that forward growth in 2026, like halfway through 2025? Could it be more? I think it could be more than that because of the acquisition. The market disliked acquisitions, and it's only for the simple reason that acquisition's bad and it's how the market thinks. But this acquisition, in my view, is really, really good. If you look at the company they acquired, Melinta, forecast to have, let's call it 130 million revenue in 2025. That's going to be added to the own revenue of Cormedix, which may be 200 million in 2025. Cormedix is already growing like a weed. So if you add both of them, you're looking at a company that could have 335 million for 2025, estimated for 2025. And keep in mind that my number here, I'm trying to predict 12 months out. What's revenue going to be 12 months out? And so that means I have to look at Q2 ended 2026. So could we have actually a 3x, more than a 3x in revenue in Q2 2026? I.e., could that growth rate be in the 200%? Maybe. And the company that they acquired, I will say I like very much. It grows a little slower than Cormedix, but they have two potential products that could get FDA approval, in which case the growth would be reignited. That's point number one. And then it still grows a little bit. You see, they still bought a company that grows at about 10%, 10-15% growth rate, and they bought a very diversified company. Look at all of these products, and again, synergies too. These products are to prevent infections, and that's the type of product that of course Cormedix sells. Cormedix sells these vials for hemodialysis. So it's called Delcath. What is hemodialysis? Hemodialysis is it's the end of a diabetic disease. If you have diabetes and it goes bad, sometimes you have to go get dialysis. This is not showing the right organ, but anyways, this is hemodialysis right here. It goes down, and you can flush the kidney, I guess is how you would call it. But what they sell with Delcath, it's a product, it's a vial, it's a solution lock that you put so that there's no infection, so that you avoid infection in between each dialysis treatment. At the end of diabetes, typically you have to go through hemodialysis, and oftentimes a cause of death when you go through that stage is an infection. And so they sell these vials at Cormedix. These vials are $200, and you just put them in the tube. And when you put them in the tube, you're less likely to have an infection. So that is the product for you. So this is a company who did an acquisition, who is not going to be a single product company anymore. This is a company that's going to be a multi-product company now. And this is a company which I think paid a fair to a low price, to this company Melinta that they're acquiring. Fair to low is what I would say, because of, like I said, that possible FDA approval for their prophylaxis invasive fungal infection. So, and they talk about that. They say, oh, there's another bonus for the team if they actually get it, and for Resio is what it's going to call. So they have one more product which could reignite the growth at Melinta, and to Cormedix, this is a major jump in growth, obviously, because they're adding 130 million to their top line, and they paid 300 million for it. So they paid a lower valuation. The conclusion is they paid a lower valuation for Melinta than what their valuation is. And again, Melinta grows a little slower, but they have that FDA approval on the new product. So I have no idea why the stock was down. I mean, the market's just selling off health stocks indiscriminately. It's like it's August, it's risk off. I think they must think health is risky. I mean, this is a company that beat both the bottom line. I don't really care about that on this channel because I use adjusted EBITDA, but they beat on revenue. The company beat on revenue. So the ramp of Delcath is going very well. The ramp of Delcath is going very well. If you look at the stock price, so again, when they announced preliminary results, they had announced the stock shot up because the numbers were going to be so good, and then it went down because of that share offering that they had to do to buy Melinta. So again, this is a highly volatile stock. Be very careful if you ever do options or things like that on this stock. That's my view. But as a long-term holder of equity, I think this dip is a gift, and I like Cormedix very much, and I like sticking to my spreadsheet. The fact that it's now trading at 0.03 is ridiculous, much cheaper than a HIMS, very inexpensive. So moving on to another stock is HIMS. Let's talk about HIMS. So HIMS, it's I don't do technical analysis, but there's a big resistance around that $50 mark, and I saw some people arguing on Twitter, did they break it, did they not break it? It doesn't really matter to me. The question is, do I find HIMS cheap at 52? And the quick answer to that is yes, I find it cheap. I think that of course the market sold off HIMS because of GLP-1, because of a slowdown of GLP-1. Their GLP-1 growth, as a reminder, was halted in Q2 after Novo removed the partnership and said, we don't want to be in a partnership anymore. So now they are just selling liraglutide, and they are selling compounded GLP-1. But of course, the total addressable market for compounding a GLP-1 is much smaller than the branded GLP-1 that they had before. So that's why there was a dump in the quarter, a slump in the quarter. But if you look at all of the fundamentals of this company's fundamentals, and for someone who's not interested in this company for weight loss, I'm not interested in this company for weight loss offering. I'm interested because I think it's the future of healthcare. I think it's preventative healthcare. I think it's, these companies, especially HIMS and LifeMD, both of them, but LifeMD maybe too, they're kind of a Netflix of healthcare. Like, I could see a world where most people who are, healthy, late 20s, early 30s, early 40s, healthy individuals get a subscription for minor treatments, and you get a subscription. So that's why I call it the Netflix of doctors. You pay $50, $55 a month, and then you get maybe an ED treatment with hair health treatment with vitamins or something like that, and you have that recurring product. And so HIMS, in this type of business model, they released a new presentation. This is what's important to see. The market share increased. We were in the 45, we're now in the 47% market share compared to the competition. The market share has increased in the United States. They are doing very well, like I said, launching new products. This is a machine. HIMS is a new products machine. They're a marketing machine. They're very good at marketing. They're launching customizable product, personalized, as they say, personalized product. Why would they do that? They do that because they want to make the product sticky. They want people to stick to the treatment. They want the treatment to work, because when you sell a subscription, people have to be happy. People have no choice to be satisfied. If they're not satisfied, they cancel, right? Most people keep Netflix because they are satisfied with Netflix. Or Amazon Prime. They keep Amazon Prime because they are satisfied with Amazon Prime. So a company like HIMS needs to satisfy the customer and make the customer happy. And how do you make the customer happy? Well, you deal with the issues of your industry. So one way they do it, of course, is to make the product less stigmatized, right? It's like, yeah, if you have ED, this is not the poorly poorly regarded blue pill, as they call it. No, this is a mint. You're having a mint, and so it makes the customer feel better, right? You're using better form factor. You're putting different compounds in one pill. One of the issue when you have to take pills for your health is that if you have multiple one, then you end up having a pill pack and you forget pills. So they solve a pain point, right? They make the product attractive. This is called the what is beautiful is good phenomenon. Very, very prevalent in marketing. You have to make the product look good for people to want it. If a product doesn't look good, people don't want it, right? This is a part of science and nature. Anyways, the last thing I want to say, and this is their new presentation, and we saw that briefly in the shareholder letter, but they have this new investor presentation, which I will be using a lot in the future. But you can see hormone health. So hormone health, they acquired capabilities in Europe from the Zava acquisition. So isn't that interesting? So maybe some of the learnings from Zava they're going to be able to bring to the United States. We know in the United States they're beginning to launch hormone health, menopause and hormone replacement therapy, as known as testosterone for men in the United States. They're going to launch that. That's an enormous market. Go to any strip mall in America, you will find a low T center or whatever. This is an enormous market that they're going after. And then longevity. So longevity is another enormous market, which sometimes for longevity, you need a prescription. As I've said before, if you take metformin for longevity, you need a prescription. Wouldn't that be nice if you could just go to HIMS and say, oh, I'm interested in metformin, but I want to take it for longevity. And there's a few other prescription things that one may need for longevity as a second or off-label use. And so you're looking at a company who's setting itself up for exponential growth because you're expanding across categories and you're expanding across regions. So do I find the stock cheap? Yeah, I find the stock very cheap. There's only been a few times where I didn't find this stock cheap, and I followed this stock for many, many years. More often than not, it is cheap, and right now it is cheap, right? So anyways, moving on to OSCR. Where do I even get started with OSCR? I mean, this valuation is ridiculous. I'm just calling your attention to enterprise value over gross profit over earning growth, 0.017. This is what you're getting with OSCR. So that is how dirt cheap this company. I think the market is slowly realizing the cheapness of OSCR. OSCR, of course, had a major drop after the big beautiful bill and the fear on Medicaid, the fear on subsidies for the individual men. Well, it's not called individual men, but for the ACA, less subsidies, etc. But I listened to the earnings call yesterday, and in the earnings call, it was very, very clear what seems to have happened, and this is something that happened to all providers on marketplace, is an increase in morbidity, i.e. patients becoming sicker on average, and that increase in morbidity might have to do with the health of people who get on ACA. That's point number one. But especially losing the healthy ones, losing the healthy individuals. They are losing healthy individuals, and of course your average looks bad, and thus your medical loss ratio start trending towards a 90%. So what are they doing for this? Well, they're doing a lot of good things that I like at OSCR. One of them is cost reductions. So they've talked about efficiency and their AI efforts, and they're letting go of some people. So there is some pain at OSCR of a business where they're very, very much focused on health, on cost reductions. So that's point number one. Less cost, and I always like to see that if a business is gonna lose money on a GAAP standpoint, and it looks like on an EBITDA standpoint, it looks like they may lose $150 million too. So again, this is a company that has $3.5 billion in cash and balance sheet. It looks like they may lose from a cash flow standpoint $150 million this year. So not the end of the world, but you would think it's the end of the world when you look at the stock price. But anyways, if you have a company who's quote unquote losing money, you like to see them, go on a diet, like if I should say so. Like you like to see them be lean, and they are becoming leaner. So that's point number one. And then point number two, they kept talking on the call about how everybody's increasing their prices next year. They're increasing their prices by double digits in all of their markets, and they're saying that it's all of the providers on the marketplace, so all of their competitors are also increasing their prices as much as they can, because this is an industry-wide problem. The increase in morbidity is an industry-wide problem, and so they didn't calculate it right this year. This year they didn't charge enough, and they're gonna charge more. So if you're part of the ACA, if you take insurance for these companies, expect big increases in prices, and so double digit. I'm assuming it's still in the teens. I think it's going to be something in the teens, but it could be more depending on the situation, right? You could have a 20-30% increase on that, and that's what happens like with these companies. So and the more we lose healthy customers, the more these prices are going to rise, and so. I think they're gonna be fine. I think these rate increases are going to pass, and they're going to pass through. And the fact that they use AI, the fact that they're able to reduce their costs, to me makes this company a buy. But don't get me wrong, I still don't like the health insurance business. It's a business that I hate. I don't like it. It's an awful business. You gotta, you have to have healthy people on the platform who don't use the product. So that's not customer centric at all, right? This is like the polar opposite of HIMS and HERS. Like I like a business that is very customer centric, that provides real value to the customers. And yeah, if these people are leaving, if these healthy people are leaving the platform, it means they probably don't see a benefit. Oh, another note on this: you have the cuts of Medicaid. This is an important point. The cuts of Medicaid that are in the big beautiful bill are going to lead people to go to marketplace to find an alternative, because they may lose XYZ Medicaid benefit and they still want to be on insurance. So we may actually see an increase in the ACA customers, right? And also they have this new segment, their OCRA segment, which they're very excited about. And so over the long run, I think this is a company that's poised to disrupt an industry that I still don't like, but I like a cheap growth stock, and OSCR is a cheap growth stock. It's a 0.017. Of course, the rule of 40 is not achieved because this year their profitability doesn't look too good. But if this company is able to grow revenue much faster next year, which they incidentally will, like if they increase their prices by 18%, you have baked in an 18% revenue growth next year, and then you just gotta get some new customers, and then you're there. This is a stock that could get back above the rule of 40. So I like the stock. I think the stock is cheap. As soon as this stock is fairly valued, though, I will exit, because this is not an industry that I like. And I have a position, of course. I have a position in all of the stocks I discussed today. All right, let's talk about a final stock that is way down, and this stock, I found it a good deal in the $15 range. So when it was trading at a 0.06 on enterprise value over gross profit over revenue growth, and now it's trading at 10. So it's a 0.04 on EV over GP over RG. This company is, and that's the one I have the least to say, except that steady heady, everything's going well. They're increasing their surgery centers. They're going to have they have about 20 of them. They may have up to 30 of them by the end of the year. Hospitals are rushing to adopt their solution, which is an innovative cancer treatment for liver dominant cancers, and it's for uveal melanoma, MUVs, I'm gonna call it. It's one out of all of the liver cancers, this is one of the most rare liver cancers, and there's only 800 to 1,000 possible patients per year in the United States who may benefit from their treatments. But they focus on the rarest form, and then their device and their machine, they are getting it developed, phase 1, phase 2, phase 3 with the FDA, and they want to go after to the more prevalent forms of liver cancer. And that's the size of the market. The size of the opportunity may be up to 45,000 cases per year. And not the 800 cases per year. But of course, for them to develop these, it's going to take them, 5 years, 7 years, depends at the speed at which the FDA moves. They may have the next one in the next 2 to 3 years, though. But it's going to take a little while for them to expand that medical device to other forms of cancer. But you can see every time they unlock so much more money, they unlock so much more cash. Keep in mind that this is a cancer that they, and again, another issue with this type of business is getting reimbursed. How are you going to get reimbursed? Well, because it's a rare disease, because it's a rare patient, it's easier for them to get reimbursement. It's easier for them to get high prices on these treatments, actually. High prices on these treatments. So the product is growing very fast. The product has great outcomes. And people, unfortunately, people who have these cancers, they want to get the best care possible, and that's why this company is having a lot of success, and it's a wonderful thing because you're saving lives and you're making money. So it's like this is the best definition of a great business. So anyways, revenue growth forward 120%, gross margin 86%, EBITDA margin, not a typo. I looked at it, I calculated it again. EBITDA margin is 40%. So you have a rule of 40 of 160. EV or JP or RG if it's 0.04. But then the stock dropped from 15 to 10. So that's the risk with these quote unquote biotech stocks, right? It's like it's they're not pre-revenue anymore. They're making money now. I invest later stage in the business, but they're still sold with basket trading. They're sold as a bucket. They're sold as a basket. Everybody's selling healthcare right now, and that's why I think all of these stocks are down. All of these stocks are dipping. There is some form of a basket trading, in my view, that leads all of these stocks to be down because, biotech bad, and they made their way into a whole bunch of healthcare / biotech ETFs. So I think that's a sectoral reason as to why a lot of these stocks are down, because clearly the underlying performance of, well, at least Cormedix and Delcath is outstanding. It is just outstanding. HIMS is just a blip in the road, and OSCR, I suppose, had a problem this year, but it had a problem on the profitability front. Didn't really have a problem on the top line front. So mixed, I would say. OSCR and HIMS. OSCR this year was mixed. HIMS this year was good. I was still very pleased with the quarter, but a lot of people own HIMS because of GLP-1, and so they didn't like it because of the GLP-1 decrease. But that's definitely not why I own HIMS. So anyways, this was not financial advice, not investment advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.